Hello everyone. Hi, welcome to my YouTube channel, all about balance. My name is Nabila and I am here to give you advice, free advice on financial planning or financial saving and whatnot. So today I'm going to talk to you about how to invest in stocks and how to invest in funds, how to build your wealth over the time exponentially. So stay with me. Okay, first question I hear from everyone: why should you invest? Okay, that's the basic question. Like, why should you invest? Why shouldn't I just keep my money in my savings account? Okay, there are multiple things to that. First one, as you have seen, inflation. And inflation is not something new. It happens every year. I mean, this year and the last year or so, the inflation has been more than normal, the average that we have seen, but generally you'll see that the average inflation is about 2% every year increase. So the same amount of money that you're making, this year won't buy you the same things next year. Basically, is that. So you lose your money. The other thing is, why can't I just keep cash? That's the old thing. Like, I have some cash saved up and it's in my house, like, paper cash. That's like the really worst thing you can do. Other than the fact that, it's more prone to getting stolen or it's not safe and it's just sitting there. The other thing you can do is put your money in a bank account. Now, bank accounts are different. There can be a checking account, there's a saving account. Checking account is where you get your money from your workplace, your job, or and you get direct deposits to your checking account. So that money keeps coming in and then you let the money sit there. Checking accounts usually don't pay you any interest. So if you want to earn any kind of interest on a bank account, you put your money in a savings account. Now, savings account also in past haven't really given much interest. It used to be like less than 1%. I think recently this year, because the inflation has gone up, the bank account interest rate has gone up a little too. So, some places you can get an interest of like 3% or so, which is not bad. So that's something that's like better than keeping cash. But the other ways you can build more cash or multiply it by 5 times or 4 times or 2 times is by investing in trading, investing in buying stocks, investing in buying funds, ETFs, mutual funds, and I will talk to you about that. Now, when should you start investing? You'll say, hey, I'm like almost 40 now. Isn't it too late to start investing? I'll say no. Whenever you think of investing, start then. That's a good time. Well, of course, I'll say the sooner the better. If you had started investing when you were in your 20s, then of course your money will grow exponentially higher by the time you retire to your age of 60 and plus. But any time is a good time. So start investing now if you haven't already. Now, the preconditions before you think about investing in trading in like stocks and funds, make sure of a few things. There are some preconditions. Make sure that your debts with high interest rate, for example, your credit card debts, and other things are, or your student loan debt, that's the worst, are paid off. So you're not paying higher interest rates on those. And before you start investing, you have some extra emergency fund of cash, for a rainy day or something happens. And that's usually like about 3 to 6 months of your expenses. So for example, you lose your job the next day, you should have saved some money to last you for 3 to 6 months. So that's kind of a basic thing. Next, I'll say don't invest your money in stocks if you need money for immediate use. For example, if you're thinking of buying a house in the next 3 to 4 months, I would say don't do the investing. You need some cash for that, cash in hand to make your down payment or moving expenses and things like that. So keep that cash. So those are some preconditions before you start investing. Now, what is a better investment? Like I said, the first thing is, least amount where you don't actually lose your money is put your money in a savings bank account, and you'll earn, a little bit of interest every year. I mean, they pay you each month. So the money is not like, same as what you put in, you're making a slight amount, a little bit, which is good. The next thing will be to invest invest in your company's 401k. So most companies offer a retirement account 401k. I would definitely recommend that you should allocate some amount of money, at least the amount that your company's matching you. Like usually they match up to like 5% or something. So you should allocate that part of your paycheck to 401k account. Next thing will be buying assets that increase in value. And buying assets, I mean not like buying a car or something, because cars usually decreases in value. Assets that increase in value are a house, a house for your living, a house for your rental money, or assets like buying stocks or shares of a company. That's called the personal savings. So we'll talk more about that. What are stocks? Like for someone new, like who haven't done any trading or don't know what it is, that was the case with me some time ago. Like I had no interest in trading, and I was like, I'm not interested in trading. I want to do something else. But later on, I realized, trading is not that bad. If you learn it, it's not that difficult. So what are stocks? Stocks or shares are literally like shares of the company. So when a company goes public, that means it's not privately owned. The company is publicly listed on an exchange. I'll talk about that too. Exchange is like a marketplace where trading activity happens, but we'll come to that soon. But we have when a company goes public, they divide their company into smaller shares. So if you have a big pie, you cut the piece of pie into small shares, and whoever wants to buy a share of the company, they pay some amount. They say, okay, I'll pay you $10. I want to buy a stock or a share of your company, and you own a piece of that pie, or you own a piece of that share of the company. So that's what it is. When you buy a stock or a share, you're owning a piece of that company. Now what that gives you is you become a company's shareholder, and you own a share of company's profits. So if the company is doing well, they're making profits each year, that goes to the shareholders. So that's a benefit. Then you also get the benefit of voting in who's leading the company, the CEO or the vice, presidents and all that of the company. You get to vote on that. So that's your stock. That's what it is. Now, what's the difference between stock trading and investing? So stock trading can be done by anyone, like any person like me or you can do stock trading. You open a brokerage account. We'll talk about that. Where you can do the stock trading. That's stock trading. I mean, there are some banks where there are traders who do trading. That's also called trading. You're trading continuously to make profit. So stock, that's another term called day trader, where they're traders actively trading throughout the day, buying and selling, and they're into make some profit real quick. So that's called active trading or day trading. Then you have another thing called investing. Investing is where you're trading but thinking like you're buying something for the long haul. You're not gonna like buy something today and sell it like next week or sell it like next month. That's not a long-term investing. Long-term investing is like you buy something today, you think this company is gonna grow, this company is gonna do better down the line, and then you keep it for multiple years. And then if you decide, okay, I want to turn some profit from the stocks that have increased in value, then you sell it. That's called actually investing, where you're making money from that. Next, you come to stock market. As I mentioned earlier, an exchange. What is an exchange? What is a stock market? So stock market is basically, think of like when you go to a market, right? When you go to a big marketplace, there's a huge hall where there are different sellers selling something. For example, like you go to a big trading event, not a trading event, like a big open market, for example, where they have like different stalls. You go to a different stall and each, vendor is selling you something. So that's a marketplace. That's a stock exchange, basically. And the stock exchanges in each country are regulated by, a governing body or a government governing body. In US, it's the SEC, the Securities and Exchange Commission, right? So that's the regulation company that makes sure that everyone is trading fairly. There's no fraud. There's no manipulation of the market. Everybody is, buying and selling as a business, not just to fool people or take advantage of them. That's the idea of SEC, right? So marketplaces where buyers and sellers come together to make trades. So in the marketplace, you'll have some people trying to buy something, like, hey, I want to buy some apples from a vendor. And someone will be like, hey, I have some extra, I'll take an example of fruit. I have some extra oranges, or I have some extra grapes that I want to sell to you at this price. So that's what it is, buying and selling. Now, the exchange that we usually talk about is done on a publicly traded companies. So for example, you have a stock of Apple, Microsoft, Tesla. Those are all publicly traded companies that are traded on the US exchange. One of them is like New York Stock Exchange, is one of them, right? So that's what it is. So that's the marketplace. Okay, now the types of stocks. What type of stocks do we have? We usually talk about regular stocks, which are also known as common stocks. So common stocks are stocks which gives you ownership of a company, you get the voting rights. The small disadvantages, like there is a high risk. You need to know which company you're investing in. So, you don't find out like a few months later, or a couple of years later, the company goes bankrupt and you lose your money. So there is a risk. But if you're investing something thinking that, yeah, this company has a potential, then there's a potential of earning really high reward. So high risk, high rewards, high risk, high rewards. Okay, then you have preferred stock. Now, preferred stocks are different kind of stocks that don't give you any voting rights. They have low end risk, but they give you a stable dividend. So you don't risk losing too much money, but you also are not going to be able to make a lot of money for that. So that's preferred stock. Then you come to, I wouldn't go much detail in preferred stock, but I would come to ETFs and mutual funds. What are ETFs? These are exchange traded funds. So exchange traded funds, think of it like a basket. For example, a fruit basket. A fruit basket will have a little bit of apples, a little bit of oranges, a little bit of grapes, some bananas, some pineapple or something. So it's like a basket of different things. So I'll say different stocks that are managed by a portfolio manager, and those are called funds, exchange traded funds. Some ETFs are like, they pick some stocks, like say top 10 stocks or top 50 stocks or top 500, which is our S&P 500. That's the Standard and Poor exchange traded fund, ETF, that has like top 500 stocks of companies that are graded or been tracked, that companies that have been increasing in value, and that, those are bunched up together into this fund. So some ETFs, like the S&P, are passively managed. So you don't pay a lot of fees to trade in those funds. And there's an advantage, is like you don't risk losing too much money, but because you're not investing in one particular stock, you have a bunch of stocks in there. So even if, like, let's say I have banana that loses in value, I still have apple and orange that are increasing in value. So you may gain some money. You're not going to lose all of it. They say the fund is going to make you profit. So that's ETF. Then the stocks can be divided based on companies' capitalization. What is capitalization? It's the money, the market value, or the market value of the company's shares. So for example, if a company has, let's say, 100 shares, and each share is valued at $10. So the company's value is, 100 times 10, that's $1,000. So that's the market capitalization of a company. Now each, of course, will be higher, like in millions or $1 billion for a bigger company. Now the companies are divided into small cap, mid cap, large cap. So small cap companies are the ones that have a market value of between $300 million to $2 billion. Then you have mid cap, which will be from $2 billion to $10 billion. Then you have large cap, which is anything over $10 billion. So that's your market based on capitalization. Then you have types of stocks. So types of stocks based on sectors. Sectors are, you have energy, you have communication, you have materials, you have industrial, you have consumer, you have healthcare, then you have IT, information technology, financials, utilities, and real estate. So those are all your sectors. Then you have stocks based on the geography. For example, you have domestic stocks that are based in the United States. But if you want to invest in something outside US, those are called international stocks. So for example, if there's some stocks that are traded on the London exchange or the Tokyo exchange, those will be called international stocks. When you are looking to diversify your portfolio, that's when you think about investing in international companies or like emerging markets that are poised to expand in the future. So that's how you can do it. And the easiest way to trade in the international stock is by investing in the US registered mutual funds or exchange traded funds that trade in foreign markets. Okay, so that's the type of stocks. Next, let's come to the market. So market, you may have heard of these terms. Hey, there's a bear market going on right now. This is a bull market going on. You hear that in news and media all the time. So what is the bull and bear? So bull is when you think the market is rising. The prices of shares are increasing. There's optimism, like positive outlook, like, the economy is growing, there are jobs in the market, everybody's making money. That's the bull market, right? And then you have the bear market. Bear market is when the market is falling. We think that the economy is contracting. There is a negative outlook, like, yeah, things are gonna go bad. Like what happened in 2008 financial crisis. Then you had the COVID crisis in 2020. Those were sort of bear markets. The market, there was a lot of downward negative outlook. Everybody was looking to I want to sell, take my losses, and there was a lot of chaos around it. So that's called basically a bear market. I mean, you could take advantage in bear market too by investing. There are ways to do that, but we'll talk about that some other time. How do you choose the right stock? Now, okay, you learned about little things like what is a stock, what is an exchange, what type of stocks are there. Now you tell me, how do I choose the right stock? Which company should I choose to invest in? Now, there are different, ways you can do that. You may hear different experiences from different people, how they invest in stock. But I would say it's something what you value. If you believe in the company's long-term potential, if you agree with the values of the company, it could be a personal choice. If you think it's going to be for continuous growth, it could be for environmental reasons or ethical reasons, or it could be something like a product that you really like and you think that, yeah, this product is really cool and I think it's going to grow in value and people are going to ask for it more and I want to buy a piece of it. So you own a piece of the share of the company. That's how you invest. If you believe in something, you buy the share of that company. That's what my advice would be to you. So as we're getting close to buying, I'll come to how do you trade actually soon, but let's talk about a few more terminologies that you'll hear in trading. Now, the one thing is trading. When you trade something, you need to know what symbol you're trading as. Symbol is also known as ticker, TICKER. That's, abbreviation of the company that's listed on the exchange. So for example, if you want to buy Apple, that would be the symbol or the ticker called AAPL. If you want to buy McDonald's, that'll be MCD. Tesla will be TSLA. So when you want to look for a company's information on public sources like some finance websites like investing.com, or I'll name a few like Bloomberg or Yahoo or something, you search by that symbol name. I mean, it lets you search by the name too, but if you know the symbol, then you're really sure that you're not investing in the right, wrong company. So that's on the symbol. Then you have buy versus sell. Of course, that's something I'm sure most people know. What is buy and sell? You're buying something and you're selling something. You're buying something that you want to buy from someone else, and then you're selling something that you own to sell to someone. Now, when you buy, what do you look for? You buy at low price, thinking that you'll make profit, and when you sell something when it's high, when the value has gone up and you want to make some profit, you sell your shares. And you buy it low, you sell it high. So that's the basic idea. Now, when you trade, there are different types of orders that you can make. There's one called market orders and the other called limit orders. Market order is when you buy something immediately at the market price. So for example, you go to a marketplace. I'll talk about like a basic, like a market, like a vegetable market, right? Or a fruit market. You go to the vendor and say you want to buy, he's selling you apples. He's saying apples are being sold for $3 per pound, right? So you go to the place and you pay him $3 and then he gives you a pound of apples. So that's like buying at the market price. You know, there's no negotiation, there's no waiting. Like, what if the price goes down? If I come back and like, you know, around 5 or 6 p.m. and they're trying to close their shops, they maybe give me reduced price or something, right? So that's when you do a limit order. Limit order is when you think the price will move to your favor, you know, maybe later today or maybe next day or maybe whatever in a certain time period, and you think you can buy it at a cheaper price, then you place the order, for example, a buy order if I'm placing at a limit price. So for the same trade that I was telling you, buying some apples, you can say, I'll buy a pound of apples, but I'll only pay $2.50, right? So I place an order in the market and I say, buy 1 pound of apple for $2.50. That's called a limit order because there's a limit price to it. So whenever the price drops to $2.50 or less, or even less, like $2.40 or something, my trade will be executed, or like my trade will be filled by whoever has, you know, is offering the price. So that's called a limit order. So now let's come to the big question that you've been waiting for. How do I trade? How do I make my first trade? Okay, there are simple steps to do that. The first thing is open a brokerage account. So brokerage account is an account that allows you to do personal trading on your own. So I would say pick one that's out there. I've listed a few brokerage accounts that I have known that I've also used in the past. And look for the ones that have a really low trading fee. Some even have like $0 trading fee. So use those. Open account. You know, they usually ask for your personal information, your date of birth, and your bank account information to connect to fund that account from your bank accounts to start trading. So do that. And before you start trading, set a trading budget. Like, how much are you willing to put into your trading account? I mean, it can be like $100 or $200 per month. So keep putting money in that trading funding account, you know, without even trading anything. Just put that money safe away in your funding account. When you have reached to like a good amount, like maybe $1,000, or you can even start from like $100 or $200. I'm just saying. So once you have that fund or your pot ready to start investing, then go to your brokerage account. And before you even do that, there are a few more things. Follow a stock, you know, pick a stock that you like. Like, it can be something that you eat every day, a stock of that. Something that you wear every day, a stock of that. Some product that you use every day, the company who owns that product. So start reading about it. Start following the stock and, you know, look every day how the price is moving every day, and check the price, how much it has moved in the last week, last month, or last year, or like last 5 years, how much the stock has improved, you know, moved in terms of price. So read that. There are a lot of information available out there. You can even do search on Google Finance. I mean, you have Fidelity, some sources like Vanguard. Those are some places that you can find stock information, and they're really easy to open your bank account, your brokerage account there. So read about it. The next thing will be another easy way to learn trading is open your 401k account if you already have one, and see what are your investments chosen in your 401k account. Usually, like, companies has pre-selected some funds for you, and they start, you know, whatever money you put in your 401k account, it gets invested into certain funds. Like, those could be some ETFs, or those could be like based on your retirement age, they choose like yearly based funds, you know, like, for example, you plan to retire in 2030, 2040, 2050, you know, there are funds chosen based on that. And those funds usually have a mix of like stocks, some bonds, some like treasury bonds and things like that. So those are taken to reduce the risk, but your money will also continue to grow over the time. So those are that's your 401k. So start looking at that, understand like what kind of funds are allocated there, and how your money has grown over the years since you started to have your 401k account. So that's the pre things that you can do before you actually start buying a stock. Now, like I said, when you're ready to buy a stock, you have been following the price for some time, you have been following that company, reading news about it, and then let's say you're ready to buy a stock now, right? So what do? You go to this brokerage account, you have some money added to your funding account, and boom, you go there, you place a buy order of however many shares you want. Start small, maybe start with 1 share. And if you're not sure what limit price to order, just put it at a market price and see how the trade gets executed. The market price trade or a market trade will get executed immediately, and you'll see once a trade is executed, you will see that you own that share now in your account, right? So that's like trading stocks. So now you have a piece of a company in your account. Now that's trading stocks. Those, like I said, stocks trading can be risky if you don't know what you're investing in, if you don't know much about a company. If you're really not sure, and if you still want to make money, increase your wealth over time, I would say the safest way and the best way, which I've also been doing, is to invest in ETFs, exchange traded funds. Now, it has been seen that ETFs usually outperform a lot of major managed funds over time. They have low cost of trading. You get a diversification on the portfolio. You're not just owning one stock. You have multiple stocks or multiple funds in your in that portfolio. And some funds give you tax benefits. Like if you have those 401k or Roth IRA, you get some tax benefits on that. So I would say start from that. There are some examples that I've given for ETFs, like you can trade in S&P 500, that's the most common one. Then you have Vanguard index of funds, which is similar to S&P 500, and you can start investing in that and then see how it grows. So I think that's my lesson for today. So go start investing, be smart about investing, and good luck to you. Thank you.